joined us right now. Chris, I guess we should start with the chairman yesterday. What did you learn from that delivery?
Yeah, so a lot of people are scratching their heads because you listen to what he had to say, and it's pretty standard fare. Hey, we're going to get to very restrictive. We're going to stay there until we break the back of inflation. The only thing he really added to it is the market believes he's blessed 50 basis points, right? And what does that mean? I think that means three things. As you point out, I think what it does is it takes the teeth out of the CPI report. Because why were you afraid of the CPI? If it comes in too hot, then maybe the Fed goes another 75 basis points. They get a lot more hawkish and we see more downside. Well, we have to take the CPI off the table at this point in time, or really a lot of the downside off the table. Two, if you look at real rates have dropped like a stone, and they dropped like a stone yesterday. 10-year real rates dropped 22, 23 basis points. Why is that important? That's important because lower real rates have been associated with a better returns to growth. And what is the equity market? It's a growth index. And the last thing that we've been saying is the sell-off year to date is really about a cost of capital correction. It's not because the fundamentals have imploded, right? This is not '08 where we've seen companies like Freddie and Fannie and Bear Stearns and Lehman Brothers go belly up. What this is about is the cost of capital is more than doubled. So if you're lowering the cost of capital, which is what the market did yesterday, then you should see a pretty good pop because the fundamentals haven't broken. So all in all, you've taken the teeth out of CPI, you've lowered real rates, and you've lowered the cost of capital. In the short term, I think that's going to push the equity market up another 2 or 3% in the coming weeks.
Chris, hearing from Fed Governor Bauman, inflation is unacceptably high. The labour market is strong. You said we've taken the teeth out of the CPI print on December 13th. Have we taken the teeth out of the payroll story tomorrow morning?
No, I don't. I think any one data point, you can get a very big number, positive or negative, right? And the market will react to that. Market is still very sensitive. Like, good news in the job market is going to be seen as bad news in the equity market, right? But what's happening holistically and what's occurring? You know, we've been talking about inflation. When do we start looking through these inflation prints? You know, the market is now beginning to believe that inflation is rolling over. Inflation, the Fed has got it. Things are going to slow down. And I think that's part of what's happening right here. But to answer your point, yeah, any one print could be exceptional and move the market. But overall, what we're seeing in the job pictures, things are beginning to ease up. What we're seeing in inflation is all your leading indicators have rolled over and things are beginning to work.
Chris, do you think we're getting a little bit too cute about the outlook, the trajectory for 2023? There is this new consensus that's been established, the idea that we get this first half of weakness off the back of bad corporate earnings and this second half of strength as the Fed starts to make a bigger pivot. Chris, I just wonder what you think about that.
Yeah, John, I think a lot about that. So in the summertime, we had this conversation. We had this conversation that numbers weren't going to go down, they weren't going to be as bad as expected, but you were going to see numbers come down in the beginning of 2023. And that was going to be weighing on equities. And I do think that's now become the consensus view. The thing that's changed now is we now have a better idea of when the Fed is going to end, where the top in rates will be. And during the middle of this year, there's a lot of questions. Well, we can't find an equity bottom if we don't know where the top of rates will be. Now we have a much better understanding of that. And I do think we're getting a little bit too cute. I do think it's becoming more consensus. And as it becomes more consensus, the probability becomes less. And so we've got to watch very carefully about what rates are doing. And that's going to be very important because of the growth component in the market and how sensitive or how duration sensitive it is.
Where do you think the greatest earnings challenge will be in the upcoming quarter?
I think it's going to be more so. You've seen some pretty good and some pretty big deratings on the growth side. I now think it's coming more so on the cyclical side. If you listen to Chairman Powell, and we're late in the cycle, and this is not unexpected, what he's looking for, what he wants, what he needs is an economic malaise. Because what he's saying is we've got to get that job picture down. The way to get the job picture down is to decrease demand, right? And so as a result, the economy is naturally slowing, but the Fed is going to force that. And where you're going to see the numbers change and change more so is on the cyclical side than the growth side. And what we're telling clients is you really want to go, if you're going to invest, you really want to go to where expectations have been lowered. And one of the places where expectations have been lowered more aggressively is on the small cap side. And that's something we're much more positive on today. We did upgrade small caps about 2 or 3 weeks ago. partly because expectations have come down pretty dramatically.
Chris, yesterday Microsoft up 6%, Apple up 5%, Tesla up 7%, Amazon 4%, Google 6%. What about big cap tech, Chris?
So we're still short software, right? We've been short software, or underweight software for the last year and a half. And what we've been saying is it's working, the risk reward is changing, and the dynamics that we're looking at for growth are beginning to change. So we're viewing these things, we're not as negative as we were before. We're viewing this as the risk reward is beginning to change, and as that risk reward changes, I don't know if tech is going to be that leadership, but I do think there's a lot of idiosyncratic growth stories that are very attractive. There's a lot of former high-flying growth companies that are now growth at the right price. And that's really what we want on one side of our portfolio. We want these SCARPy names. We want names that can work in a lower growth environment where inflation is more benign and they can power through the situation.
We want you back on this show soon, Chris, before year end. It's been great to catch up. Chris Harvey there of Wells Fargo. Thank you, buddy, as always. 10 minutes into the session, we're up 1/10% on the S&P. On the NASDAQ, we're up almost 0.2%. Shares of Credit Suisse, to pick out one single name, falling for a 13th consecutive session. Close here. Longest losing streak on record. Abby has more. Hey, Abby.
Hey, John. Well, this is really pretty incredible. As we have stocks rallying here in the U.S. 2 months in a row, we have these shares of Credit Suisse, both in Switzerland and the ADR here in the U.S., absolutely quietly plunging, and that record streak to a record low, as you were mentioning. The recent move lower, because this, of course, comes in a greater than 95% fall from the peak, has to do with the recent rights offering that could bring dilution. Now, before we speak more about that, the reason that they have the rights offering is a part of that $4 billion capital raise announced a few weeks ago for the transformation of the company, because, of course, they've been racked by a number of scandals. They've also talked about a fourth quarter loss potentially of $1.5 billion, lots of money coming out of their key asset management business. So lots of problems here, and Archegos was one of those scandals. Lots of fines paid over, not just the recent years, but they've had a lot of scandals and problems over the last decade or even longer. But as for that rights offering, John, 2.52 Swiss francs, that's the key level. If the stock in Switzerland can stay above that level, then perhaps the dilution will not happen. But if below that level, according to one analyst, it could really be a problem. And it will be interesting, John, because you can see that this recent selling, all of the selling, the last peak closer to 2,000, it's on higher volume. But if it holds that level, will investors see some sort of near-term trade there as this company tries to get itself together? But certainly catch a falling knife there.
Abby, thank you. Thank you very much. It's a challenge to hold on to clients in an environment like this one. We heard from the Credit Suisse chairman a little bit earlier this morning, who said we have had very few clients leaving. We will see client money coming back. We actually heard from the UBS chairman at a conference in London in the last 24 hours, who said we are not actively benefiting at their expense. He went on to say, we view them as a worthy competitor going through a crisis which I believe they will manage and get to safer ground, but we are also in a world of clients moving money around where clients proactively approach us. An indication from UBS that Credit Suisse clients are going to the bank proactively. The latest. I just can't believe we're seeing a two-handle on Credit Suisse this morning. More on that, no doubt, through the next month or so, going into a new year. Coming up on this program, investors turning their attention to Friday's payrolls report.
Recent research by Fed economists finds that the participation gap is now mostly due to excess retirements. These excess retirements might now account for more than 2 million of the 3.5 million person shortfall in the labor force.
That conversation up next.
Overall participation, however, remains well below pre-pandemic trends. Recent research by Fed economists finds that the participation gap is now mostly due to excess retirements, that is, retirements in excess of what would have been expected from population aging alone. These excess retirements might now account for more than 2 million of the 3.5 million person shortfall in the labor force.
Chairman Powell and investors alike paying close attention to the labour market. The US payrolls report less than 24 hours away. This as DoorDash plans to lay off 7% of its workforce, joining the growing list of tech firms cutting jobs. The CEO writing in a letter to staff, while our business continues to grow fast, given how quickly we hired, our operating expenses, if left unabated, would continue to outgrow our revenue. Ed Ludlow joins us now on the West Coast alongside Mike McKee here in New York. Mike McKee, I want to start with the data ahead of payrolls Friday. It's the data we got just a minute ago.
Yeah, we just got the S&P version of the PMIs for manufacturing for November. Now, this is a final. It's 47.7. Their preliminary indication was 47.6, so marginally better, but still below the 50 line that theoretically tells us whether business is contracting or not. It is different construction a little bit than the ISM number at the top of the hour, but both will get some attention today.
I think we're looking ahead to the ISM employment component as well, given what happened with manufacturing and the ATP, and payrolls just around the corner. Speaking of payrolls, Ed Ludlow, the job losses in tech just piling up and piling up.
Yeah, the data is staggering. DoorDash interesting because it's a company that continues to grow both in terms of bookings and the top line, but they're trying to unwind the pandemic era mega growth, right? It's a similar story in Amazon trying to unwind the investments that they made, and they've become bloated, so they're starting to cut jobs. I actually want to get straight to the data, John, from Challenger Gray because it is staggering. In the month of November, the technology sector announced almost 53,000 jobs to be cut, taking the year-to-date total to around 81,000. I'm actually going to say that again, John. 53,000 job cuts announced in tech in November, taking the year-to-date total to 80,000. All of it coming in the month of November. That is the biggest month since this firm, Challenger Gray, started recording that data set. And the year-to-date total of 81,000 jobs announced, the biggest since 2002. So something clearly happening very sharply in the technology sector. The other piece of data that really caught my eye, John, and I'm grateful to be on the show this morning for that reason, the majority of job cuts announced in November came from the West Coast in particular. And so that is worth looking into. Pay is also a really big issue right now because people are looking for new jobs. You know, we've been talking a lot, for example, about Twitter, those that left of their own volition and those that were laid off. Well, I know, talking to sources, the kinds of firms they're going to, but they're not able to command as high a pay as perhaps they had at their previous firm, which is an interesting dynamic when we think as well about inflation in the context of wages.
Hey, just how much excess is there? I saw a Wall Street Journal story over the weekend that was explaining just how much the likes of Amazon and Meta have grown through the pandemic. We're talking about workforces that have basically doubled at some of these tech firms.
Yeah.
How much excess do we have left that we need to remove?
There is excess, and I'm hearing from a lot of folks in this town and broadly out in the Bay Area that are struggling to find a job. But a lot of venture capitalists will say something else, John, which is that if you go back to the dot-com bubble, 2008, when you see layoffs like this, you actually release a lot of talent, and what that talent does is they found their own companies. Good companies are born out of recessions, and what's interesting is that dynamic itself is also offset by this idea that a lot of mid to late stage growth companies right now in the private space are also being told by their boards to have discipline and not hire like crazy. So it's a really hard balancing act. But yes, there's excess. I think what will be interesting, and we see the give, actually, is if they might be overdoing it a little bit. You take HP Inc. as an example, up to 6,000 jobs over 3 years. But what we're understanding there is that actually they want to give themselves flexibility, because if you cut too hard, you may not be able to hire those people back, and then you're left stranded if we see a quick turnaround in the economy.
Ed, thank you. Appreciate it, buddy, as always. Mike, I want to give you the final word on this as we push ahead to tomorrow morning. Mike, we just start with Challenger. Maybe some people out there not familiar with Challenger job cuts. How useful is that data, Mike?
In a directional sense, it gives you an idea of how things are going, but they include potential job losses, not just from firing people, but attrition, and if you're cut back on hiring plans, it all goes into that. So it doesn't really mean that 81,000 people are losing jobs, but you want to find a word on this. 81,000 jobs lost, even if that were the actual number in the month of November. Well, in the month of October, the economy cut 300,000 360,000 jobs. Now, we saw job gains because more people were hired, but that kind of churn goes on all the time, and you can see the relationship of the tech industry to the overall economy. 153 million jobs out there, so 81,000 isn't much. Gets a lot of headlines, but it's not really a story of what's going on in the labor market right now.
Final word on jobs tomorrow, Mike.
I think what we're going to see is a slowdown. That seems to be the indication. We'll get a better look when we get ISM. You mentioned the manufacturing employment numbers. But it's also important to keep in mind that what happens is unemployment doesn't tend to rise until after the Fed stops raising rates and even starts cutting rates. So there's a very good chance that if we're going to have labor market problems, we haven't gotten there yet. So no matter what the numbers say tomorrow, it isn't going to be the final word.
ISM in about 8 minutes. Mike's going to break that down with Alex Steele, Guy Johnson and the team in 8 minutes time. Payrolls Friday just around the corner. Equities right now about 22 minutes into the session, positive 0.4%. We add some weight to the rally through October, through November, now into December. The Nasdaq up by 0.5%. Let's get some sector price action. Here's Abby.
John, we have something interesting happening sector-wise that suggests that investors really do think that the Fed could back away. And what I'm talking about is we have utilities and real estate, two of the top three sectors up about 1% apiece. These sectors, of course, give high dividends, have these companies' stocks offer high dividends, and that would be competition to yield. So if this strength for utilities and real estate continues, it suggests that traders, investors think that yield will go down, perhaps on the Fed being less hawkish than previously expected. As for those 2 months, take a look at this, John. All 11 S&P 500 sectors higher for the quarter so far. Energy, industrials, materials, old school, old economy sectors leading the way. And then take a look. The worst sector, underperforming, up 1.4%. Discretionary, as we still figure out what's happening with the U.S. consumer.
Abby, thank you. Stocks advancing, your trading diary. Up next. Almost 26 minutes into the session, stocks are up by 0.4% on the S&P 500. We advance once more. That's the price action. Here's the trading diary. Coming up at the top of the hour, ISM. Then the president and French leader Emmanuel Macron holding a news conference at 11:45. Fed Vice Chair for Supervision Michael Barr speaking at 3 p.m. More Fed speak. Market and Evans on Friday, and finally closing out the week with Payrolls Friday. All-star lineup on this program tomorrow. Do not miss it. Mohammed Al-Arian, Rick Reeder. We'll hear from Anastasia Amoroso and Michael Collins from New York City. That does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
from the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, December 1st. My goodness, here are the top market stories that we're following for you at this hour. A cool breeze for hot inflation. Core PCE moderates while spending and income rise. We get the latest read on the economy with Tim Fiore, chair of the ISM Manufacturing Business Survey Committee, as the numbers drop in just moments. And watch out for 2023. JP Morgan says U.S. stocks could see sharp declines in the first half of next year and retest lows of this year. Equities taken in stride, S&P up over its 200-day moving average. And an exclusive interview with a commodities giant. We're going to speak to Cargill's outgoing CEO, Dave McLennan, on the state of the global economy, inflation, and China. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. All right, S&P's given up a little bit of a gain here. What did the numbers say?
Okay, they're all sub 50. I think that's the kind of first takeaway. So let's work our way through the numbers we're getting from the ISM. This is manufacturing data. 49.0 is the headline number, down from 50.2. The economists expected 49.7, so we're sub that. You've got a prices paid number at 43. That weakens from 46.6. Again, below expectations. New orders at 47.2 versus 49.2, and employment at 48.4, down from 50. So I would say soft data, Alex. Your read?
Yeah, I thought the employment is actually quite interesting, below 50 at 48.4, and how much of that is sort of a good slowdown versus a more negative slowdown, right?
Yeah, we've also had, remember, the ISM data alongside the PMI data. The PMI data coming through at 47.7, so both kind of leaning in the same direction. Let's get a take on what is happening here. Tim Fiore is the chair of the Institute for Supply Management's Manufacturing Business Survey Committee. He joins us now, as ever, to work our way through the data. We always appreciate it, Tim. Thank you very much. How should we be reading these numbers?
Yeah, good morning. So I think you were right on it, Alex and Guy, is that it's soft. Definitely at 49, we're now in a contraction mode for the first time in 29 months. I think the issue, there's a big issue here around employment that we can get into too. But so demand is pretty much fallen off now. We've had 7 straight months of softening demand. We're now consuming our backlog. Backlog came in at like 40, which is pretty low. So rather than working on new orders coming in, we're working on backlog, including overdue. New export orders stay weak. The new order level is at 47. Not overly alarming, but consistent with trying to consume all that virtual and physical inventory that was loaded into the system due to over-ordering way back early this year. So, yeah, I think for sure we're now in contraction mode. We've broken the cycle here at 29 months. The average cycle for expansion over the last 20 years is about 34 months. But I don't think there's a lot to be alarmed here. On the supply side, suppliers continue to deliver faster. And I think, Guy, you hit it on the prices side. Our prices actually contracted faster this month than last month. And I think we had 88% of the respondents reporting the same or lower compared to the month of September. So I think we're heading in the right direction. As a point of note, 67% of manufacturing GDP is currently in contraction, which is up from about 27% back in September.
Wow. That happened really quickly.
Yeah, it did, but it's not a big fall off. I mean, 49, 51, okay. 50 is the break point, obviously. You're expanding at 50.1, you're contracting at 49.9. So we're at 49. Not that concerning. I've been predicting for the last 2 or 3 months that we're looking at a 48 to 52 period month to month, and we're in that range. So this is the third month at 49 to 51. It's in that 48 to 52 range. It's not a big fall off, and I think that's the real message here. But there's some interesting information on the employment side.
Okay, let's talk a little bit about that. Up until now, we've seen manufacturers hoarding labor, Tim. Are we starting to see that come to an end?
Okay, so we're still in a 2-to-1 hire to fire ratio, and that fire includes attritions and freezes. And up until last month, it was by far freezes and attrition. In the month of November, we actually had the layoff piece come into play. So of the total comments around hire and fire, and 14% of those were around layoffs. So in the prior months, it was like 3-4%. I didn't even really bother counting it back then. I went back and looked at it. So we went from 4% in September, October to 14% in November of companies actually laying off. So it's begun, and I think the last time we talked several months ago, there was concern about the moderate to long term, which is really Q1 output, and is there enough demand to support that? There wasn't really a lot of concern around finishing off 2022, and I think that's still the case. I think December is still going to be a pretty good month. I think we're still going to be in that 48 to 52 range.
Tim, can you give me an idea of how companies are looking at the firing part of it? So are companies anticipating they're going to have to let go more workers as it goes? Are they being really cautious in doing it, or is this kind of it?
Well, the comments I get are around layoffs, and this fires layoffs, and it's immediate. It's not we're talking about it next month or the month after. We're laying off now. So I think companies did take some action in November. Much better to do that than the December time period around the holidays. You don't want people to go out and drive up their credit card debt and then find they don't have a job. So I think November was kind of the month that they had to pull the trigger. Those that really didn't see a strong amount of demand in January and February. May continue in December. I think still, with the demand, with companies working off their backlog and their overdue at a very large extent. I mean, our backlog number, the Fusion Index came in at 40, which is pretty low. We peaked out at 65 a year or so ago. With the new order rates really being slow for the last 4 or 5 months, that's what happens. You work on your backlog. And at some point you say, okay, I don't have enough backlog here to support the headcount. It's time to kind of release them. There was a lot of comments here about trying to make sure they protected the higher quality workers. But if you're going through a 2 or 3 year period of hiring, you end up hiring people that you may not want to keep long term. And that's the first wave, and that's probably what happened in the November timeframe.
Tim, is there any way we can be sector specific in terms of where we're seeing the weakness in manufacturing? Are we seeing it in the auto sector? Is it in exports? I'm just wondering what is happening here at a little bit more of a granular level.
Yeah, so exports are still weak. Combination of the heavy currency and the weak markets, both in Europe and China. Comments still around that. On the industry sector side, we only had a couple that actually expanded of the big six. So the big six make up 70% of manufacturing GDP. The only two that expanded and didn't expand really strongly was transportation equipment, which includes autos, and petroleum and coal product, which is a refinery area. So we had computers contracting at a marginal rate. Chemicals for the fourth straight month has contracted again. That's a foundation industry that supports everybody. Machinery contracted, food and beverage contracted, but all very lightly in the 48, 49 range. So it's pretty much wide scale at this point. 67% of manufacturing GDP is in a contraction mode.
Tim, look, we really appreciate it. Getting the instant analysis and, breakdown of the data is so valuable. Tim, thank you so much. Tim Fiore of ISM will get you next time as well. You should point out that the S&P giving up its gains, though still above its 200-day moving average, now up just 1/10%. So coming up, we're going to get the market reaction here and also what to make of Jay Powell's remarks and ask why investors just seem to be fighting the Fed at this point. Emily Rowland from JH Investments joins us next. This is Bloomberg.
When you get 15, 20% moves that go against you, you don't want to miss it. And sometimes we get it right, sometimes we don't. This one we did. So we think it can extend here now. We think rates will go lower. We think, Powell's commentary is right in line with what we've been saying, which is that they're going to pause probably in January. And the market's getting in front of that. And this is a classic, kind of Fed pause stock market rally.
Tomorrow, all eyes are on the jobs report.
Jobs report Friday is going to be huge.
It's the final stretch of 2022.
Is there actually going to be some change in the tone?
Wage data might be more important than the CPI.
Tomorrow, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is stronger than people have thought it would be.
The recession is not here yet, but the check is certainly in the mail.
We're going into a downturn at full employment.
The November jobs report, tomorrow on Bloomberg Television and Radio.
For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. We anticipate that ongoing increases will be appropriate. It seems to me likely that the ultimate level of rates will need to be somewhat higher than thought at the time of the September meeting. The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, it is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy. Despite some promising developments, we have a long way to go in restoring price stability.
That was Fed Chair Jay Powell indicating a slower pace of rate hikes may be ahead. And yesterday that sparked a widespread risk-on rally, which had some scratch in their heads. So our question of the day is, are markets actually fighting the Fed? Joining us now, Emily Rowland, JH Investment Management Co-Chief Investment Strategist. And I appreciate that we're giving up the gains today on that ISM data, Emily. But did the markets get the Fed wrong yesterday?
Yeah, I didn't hear all that much new from Powell. I think the markets had already priced in 50 basis points in December, and he, confirmed that the pace of hikes is going to be slowing. I think that there was some risk out there that Chair Powell would kind of push against easier financial conditions. So I think maybe that overhang was sort of removed from the markets, and then we were off to the races. But I was certainly surprised a bit by the velocity in the rally in equities yesterday after that speech.
Emily, is the markets, are equities in any way priced for rates north of 5%? 5.25, 5.5, 5.75, because that seems to be the territory that Powell may be aiming for.
Yeah, I think, we have seen this just massive risk-on rally, and it's a bit of a head-scratcher given the macroeconomic environment that we're in today. And we've seen, the data this morning come in softer, so we've seen a bit of that kind of exuberance kind of come off in the markets right now. But, you think about this rally in markets, and it's all been multiple expansion. We're back at 17 and a half times forward earnings on the S&P 500 right now, which is above 20, 30-year averages. So stocks are by no means pricing in more rate hikes. They're not pricing in a potential recession in 2023. We have to remember that Fed policy works with long and variable lags, and it's very likely that we have not felt the full impact of Fed tightening. It takes 3 or 4 quarters for that to actually filter into the economy. So we think we're setting up for a bit more of a challenge into next year.
Right. So you have the Fed basically looking at the data to help determine that, but then the market's looking at the Fed and trying to game them. When the market games them like yesterday, how do you play that? Like, do you need to sell rips at this point?
Yeah, it's really tough because I think it's so easy to get whipsawed. And, frankly, Alex, I think that there's a lot of kind of sentiment and positioning dynamics at play right now. We want to be really careful about trying to swing for the fences here, and we don't want to overplay this idea of a Fed pivot. I think one thing that's lost in a lot of this is, yes, there's some excitement in markets that inflationary pressures are coming down. There's some excitement here that the Fed is slowing, but we need to remember that rates are coming down and the Fed is slowing the pace of hikes because this inflation problem is actually turning into a significant growth problem. And the Fed, remember, is looking at backward-looking economic data. And we don't let friends use backward-looking economic data. We're looking at forward economic data, which is suggesting to us that we're not in a recession yet, but it's coming. And markets are first they're pricing in the recession. Now we're already pricing in a recovery. We're getting way ahead of ourselves here as we head into next year.
I know what I want for Christmas. I want some forward-looking data. Emily, the rest of the world, Liz, a little bit. Emily, the rest of the world is outperforming the United States. A lot of that's China. Does that continue?
It's really just amazing. You know, you look at European equities and they're up almost 20% on a quarter-to-date basis. Certainly something that's been really surprising to us, given the fact that there's massive challenges from an economic standpoint, from an inflation standpoint. Europe very likely in a recession, and we've just seen this massive rally, which I think started with a short covering element and then sort of turned into, you know, macro trading and momentum strategy, starting to scoop it up. You know, it's something that we would fade into next year. We don't want to own more cyclical, more economically sensitive parts of the global market, and that's what you own. When you own European equities, it's financials, consumer discretionary, industrials. We want to fade that. We want to embrace higher quality and more defensive parts of the market in areas that can hold up in a decelerating growth climate. You're just going to find more of that in the U.S.
So where in the U.S., and is it in stocks or it is in bonds? Like, where can you get the cheapest safety?
So, you know, you guys mentioned our, you know, Christmas shopping and what do you want for Christmas? You know, think about kind of there's a bond store and there's a stock store.
Speaking my
right
language.
now. And yeah, exactly. And a shoe store, but maybe we can talk about that offline, Alex. So at the in the stock store, there's just not a lot on sale right now. You know, we talked before about this element of multiple expansion that we're seeing. There's some areas that are on sale that we like. Mid-cap equities are one. Quality stocks have underperformed the S&P 500, which we think is a really odd dynamic right now. But if you look at bonds, you are getting an opportunity to find areas that are on sale. Investment grade corporate bonds, one of our favorites, offering 5 to 6% yield right now and trading, frankly, at 2008 type levels at 85 cents on the dollar. So that's really where we're looking. If you are a bargain hunter, you know, this holiday season, as we all are very astute shoppers out there, you know, I think that's the where we would be looking, is walking into that bond store.
Okay. The bond store sounds more exciting than the stock store, but the stock store sounds like a sock drawer, so maybe that takes us to the shoe story. Emily, crypto, are we done with crypto? Is it over? Or is something going to come out of the ashes?
Yeah, really interesting. I was glued to the interview last night, as many of you had heard. You know, I think it's an asset class, if you want to call it that we've you know, really never been able to figure out what drives it other than sentiment and momentum. So it's not something that's ever been part of our, you know, consideration at John Hancock Investment Management. We really don't know what drives it. There's no fundamental there, you know, kind of analysis that you can do there, and that's what we try to do. So we've always looked at it as kind of our gauge of, you know, where sentiment is at. And I think that, you know, certainly that should continue. We'll be watching it, but that's really all we can kind of glean from the crypto market.
Emily, Alex has many things to say about the shoe drawer.
Offline.
But
Offline.
I'll definitely leave that one offline. She's got a whole cupboard. I built a cupboard to house the shoes.
You can draw them out. It's great. It's my favorite place in the whole house.
I can relate to that.
It's an amazing thing to see. I've seen pictures. Emily Rowlands of JH Investment, thank you very much indeed. Mr. Gorman is speaking at a Reuters conference. He's saying some pretty interesting things. He's talking about the fact that it, quote, makes sense to modestly adjust the firm's staffing. He's also talking about what is happening with Twitter. Twitter's a great company. Elon Musk is a great executive. I would not bet against Elon Musk. The words of Mr. Gorman speaking at this conference. We are going to take you to Silicon Valley next. The latest Challenger report saw US job cuts rise by 415% compared with the same period last year. The tech sector in November has been absolutely battered. This is what they're talking about in San Francisco. We're going to take you there next. This is Bloomberg.
At that all day yesterday.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishika Gupta. One of the largest grocery chains in the U.S., Kroger, has raised its earnings forecast for the full year. Kroger also posted third quarter sales and profit that beat estimates. Meanwhile, the company has put share buybacks on hold whilst it tries to complete a proposed $24.6 billion takeover of Albertsons. It's one of the biggest casino deals in the U.S. this year. Blackstone has agreed to sell its 49.9% stake in two Las Vegas hotels to VICI Properties, which owns the majority stake. Blackstone will get $1.27 billion in cash for its share of the MGM Grand and the Mandalay Bay. It will also resume Blackstone's share of the debt. And the missing billions from the collapse of FTX are still a mystery. The disgraced founder of the crypto exchange, Sam Bankman-Fried, is denying he was behind a fraud.
Whatever happened, whenever it happened, I had a duty. I had a duty to all of our stakeholders, to our customers, our creditors. I had a duty to our employees, to our investors, and to the regulators of the world to do right by them, to make sure the right things happen to the company. And clearly, I didn't do a good job of that. I was shocked by what happened this month.
Bankman-Fried spoke at the New York Times Deal Book Summit. And that is your latest Business Flash, Alex.
All right, thanks so much, Ritika. So let's stay with that for a second. It is 20 past 7 in San Francisco. Let's get to the startup, where we cover the top tech stories brewing from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-anchor Ed Ludlow. Hey, Ed, let's stick with Bitcoin for a second, or crypto, I should say, because Gorman's talking about that right now at that Reuters summit. What did you make of SBF yesterday?
Yeah, it's an interesting one. I mean, out here on the West Coast, people are paying attention, right? Sam Bankman-Fried is a Bay Area native, born to Stanford professors, and a lot of the VC firms, the kind of storied legacy VC firms, are impacted, right? You think of Sequoia had exposure in terms of low single digits of its broader assets under management, but still had to mark down the value of that investment in FTX. And yeah, everyone's talking about how there's a degree of contrition from SBF, right? But still more unanswered questions than we got answers. There's an $8 billion black hole on the balance sheet of all of those companies. Commingling, a word I've not heard in a long time. There was no commingling. In other words, the use or spread of customer funds between FTX and Alameda, and I know that was a big question as well for those that use FTX out here on the West.
James Gorman, crypto is a shiny new toy. People got overly excited. They certainly did. Yeah. Ed, let's talk about what people are actually really focusing on, I suspect, ahead of Christmas, and that is the layoffs that we're seeing in Silicon Valley. We've seen the Challenger numbers today. Tech has been badly beaten.
Yeah, the Challenger numbers are interesting. I would say that those are job cuts that are announced rather than enacted, and they come in many forms. The tech sector that Challenger Gray covers is a number of subsectors like hardware, software, IT more broadly. 53,000 jobs cuts announced from the technology sector in November. There's only 81,000 year to date. You know, that gives you a sense of scale of how quickly things are accelerating in terms of the number of firms that are announcing cuts. That 53,000 job cuts announced in November across the technology sector is the highest number since Challenger Gray started recording the data in 2000. And the year-to-date total is also the biggest year-to-date total so far for the tech sector since 2002. In other words, things are getting serious, right? Mm-hmm. I think the other piece of data that caught my eye is across all sectors, a lot of these job cuts are happening here on the West Coast, not on the East Coast or in the Midwest. Here, across all sectors, I think we've got to start digging into why.
So, okay, Ed, why? But also, I guess, is there palpable concern in the Valley about this, or is everyone kind of taking this in stride, and is there a conviction that you can just get another tech job no big?
So there is. You just showed some images of the companies that have announced layoffs, right? DoorDash, a really good example. DoorDash is actually a company that's growing. You know, it was a pandemic darling. It continues to see revenue growth and also gross bookings growth for food delivery. But it got so bloated during the pandemic era that it's now having to react and use job cuts as a cost-cutting mechanism just to make sure expenses don't outpace revenue, which is worrying for a lot of firms out here on the West Coast.
Okay, we've woken up. Bloomberg's technology co-anchor Ed Ludlow. Thank you very much indeed. Coming up, we're going to talk food. We're going to talk food inflation. We're going to talk to the food giant, Cargill, its executive, Dave McLennan. Next.
All right, about an hour into the U.S. trading, we're rolling over here. The S&P up by about 0.6%, although still slightly above that 200-day moving average. This comes up the ISM data. Was pretty heavy. Let's go to Abigail Doolittle. She's tracking those moves. Abby?
Yeah, well, Alex, we are coming off those two big up months for the S&P 500, but to your point, rolling over just a little bit. This looks more dramatic than it is, down about 0.5% on the session on that weaker than expected ISM data, or also perhaps yesterday some of that big rally had to do with end of the month window dressing, and so cooler heads prevailing right now. As for some of what's perhaps helping earlier before we had this drop off on the ISM, we are getting some cooler economic data suggesting that the Fed's hawkish stance, I should say, overall, all of the rate hikes that we've had in recent meetings, 75 bips back to back to back to back, is starting to work. The PCE numbers are a little bit more attractive, but you can see that the ISM numbers, that they are in contraction territory, so that is good on the one hand. It suggests that the economy is cooling off, and you can see construction spending is also down. On the other hand, it could really mean that we do have this recession coming up in 2023, and how bad will it be? As for the S&P 500, I would suggest that the last 2 months in terms of the big rally has everything to do with the dollar. On top, we're looking at the S&P 500. On bottom, we're looking at the dollar. And so here's this year's bear market. The key here in terms of whether the bear market stays in play is not just above whether we stay above that 200-day moving average. It's really interesting because we've been talking about this over the last couple of months. Would we make it up there? We have indeed. But will we take out August high? If we take out the August high, that could mean something serious for stock bulls. It'll probably have a lot to do with the dollar. If the dollar continues continues to breach that 200-day moving average support, it could be a real risk rally, and perhaps driven by the idea that the Fed's not going to be quite as hawkish as they have been. Finally, relative to the sector composition in November, I don't even have to mention the fact that China tech stocks were up 40%, the best month ever. That was incredible. All 11 S&P 500 sectors higher, driven by energy, financials, materials, or lead, I should say, industrial, some of those old economy sectors, Alex. But take a look at this on bottom, discretionary. It seems as though the U.S. consumer not quite sure, some of those stores, some of those companies, retailers, not doing quite as well as some of these other areas of the economy, but nonetheless, all up in the month of November.
Yep, great stuff, great stuff. All right, Abigail, thanks very much. So that is the view of the markets. Let's get the view from the C-suite now. We are joined by Dave McLennan, Chairman and CEO of Cargill. Cargill is one of the world's largest agricultural companies, huge trading arm, has its hands in every area of the world. This is Dave's first TV interview since announcing he's going to step aside next month. David, so good to see you.
Good to see you, Alex. Thanks for having me back.
You bet. We're going to get to a lot of different things, but I wanted to start with the broad macro for a second. Everyone's kind of dealing with inflation that's moderating a bit and growth that seems to be slowing maybe a little harder than we thought. Mm-hmm. You see everything. What's your take?
I don't know we see everything, but certainly in the world of ag and food, and I would concur. So we are seeing some demand destruction, things like people consuming less beef, less high-end beef, and rotating into, say, chicken or fish, or eat at home as opposed to going out to restaurants. Prices, especially in the primary ag commodities, wheat, corn, soybeans, have stabilized for now, but that certainly can depend on weather, supply chain disruptions. But overall, I'd concur, moderating, but with some demand destruction as well.
What do you think we're going to see in 2023?
I think it'll be more of the same. I mean, certainly I'm not an economist. There's a lot of people that spend their whole career and life
But you kind of are. You're like a food economist.
We get to see, you're right. I think, as we were saying, not as abrupt recession in the U.S., but certainly keeping a close eye on Europe as they go through winter, potential for energy disruption. So a tentative outlook, but generally more of what we're seeing right now.
Dave, good morning. It's Guy. I will add my thanks to Alex. It's great to see you in the studio. One thing I'm seeing in a lot of the inflation data that I'm looking at, though, is that food prices are proving to be stickier than a lot of other inflation that we're seeing right now. A, would you concur with that, and why do you think that is?
I think perhaps they're stickier, but I think they are generally trending down. I think a lot of the supply chains are very tight. So disruptions from what has been happening in Ukraine, although the food corridor being open has really made a difference. Continued labor shortages in certain markets, so the inability to run at full capacity because of labor shortages. And then certainly weather-related supply chain disruptions. As you know, Guy, there was Mississippi River levels that were very low this summer, which have recovered somewhat. But so I think there still are some kinks in the supply chain that may be causing that stickiness.
You mentioned Ukraine, so let's talk about it in a little bit more detail.
Yeah.
How are you managing that? What's going on? Can you give us a read of what is happening on a day-to-day basis?
Well, for now, we're able to get new crop out of the country and to the places that it's needed in the world, specifically Africa and the Middle East. We were able, once the food corridor opened up several months ago, we were able to get old crop, which had been sitting in ships or in storage. And so now the crops that were planted by Ukrainian farmers last spring when the conflict first began are now being able to get out of the country. So we are not, our crush facilities are not available for use to protect our employees, to keep them safe. We are crushing sunflowers there. But in terms of our export business, working with farmers, helping them get their crops out of the country, get cash into the country, that is going pretty well for now.
For now. For next year, how are you able to finance that business and also for next year's seeding?
Well, that's going to be the question, and that's the challenging and interesting and fascinating part of ag, is every season's different. It might be weather, it might be access to seeds and fertilizers, so it's tenuous, but we're going to look to next season for planting and for them hopefully getting the supplies and getting the right weather for their crops, but that could change if the conflict situation changes, if the weather situation changes, but optimistic that we can continue to get crops out of the country.
Let's go to changes. China undergoing some big changes. We spoke to the BHP CEO yesterday on China and what he's looking at for next year. Here's what he had to say.
China is going to provide a bit of stability to global growth over the next year. So as we see weakening growth in Europe, potential for recession in the U.S., we think that China is going to be a stabilizing factor for global growth.
That's from the metal side. From the ag side, do you feel the same way?
I probably not quite would agree with what he said on the ag side. Nonetheless, I mean, you're seeing demand destruction with the result of contraction in China because of COVID policy. So a lot, like everything, is going to depend on where that goes. Do they continue to have outbreaks? Significant part of the world for ag consumption and certainly a market for American farmers to sell their products to. So, but it is a slowing economy, and whether it provides stability to the rest of the world in ag, I think that remains to be seen, but perhaps I wouldn't characterize it quite the way that he did.
What are you expecting? I was starting to see maybe, Dave, a softening on COVID zero. If we do see a softening, do case counts climb, but maybe people are out more, so they're going to be consuming more? It's an incredibly complex issue to navigate. How do you actually, again, how do you manage this a week out, 2 weeks out, a month out? Is that how you're thinking about it? Are you just going to have to be kind of responding to what you're seeing on the ground, or can you prepare for any of this?
Yeah, I don't think you can, Guy. I mean, you kind of have to take it week to week, and in some cases, day to day. And so these outbreaks, as we all know from our own experience here in this country and Europe and elsewhere, it can happen very quickly. And so the question, for the world to ponder is, how do they move, or do they relax off the zero COVID policy? What does that mean for their economy? And then to the point you just made, if they relax it and then people go out and then you get, higher spikes in case counts, and then, does it become this cycle? So it remains to be seen, but you have to be short-term focused relative to what's happening in that particular situation, COVID and the Chinese people and the Chinese government.
Let's just think about what is happening in the United States right now. Potential rail strike. Again, what are you thinking about? How are you preparing for it? Do you think it's going to happen? What is your view?
It is, yeah.
I think that was the answer.
Yeah. It can't happen. I mean, the devastation on the American economy is well known, and somebody came up with the figure $2 billion a day. Certainly for the ag economy, you can't make up in truck, river freight, barge what you would lose from rail capacity. And not only just getting crops out and getting them shipped around the world, but also like USAID, we ship our grains from one of our facilities in the south in Texas to go on ships that then go through USAID to emerging economies and people that really need the food. So it's going to disrupt food security as well as the American economy. So we are choosing to be optimistic. The news was good out of the House yesterday. We've been making our voices known because you can't wait till December 9th. You have to start making preparations several days, let's call it 48 hours. So December 9th is next Friday. So if it looks like there's going to be a strike, things start to have to shut down 2 days ahead of time. And then if it gets settled, when it gets settled, it will take days to come back. So I really am going to hope to be optimistic that it gets solved one way or the other, and that certainly the bill gets through the Senate very quickly.
So the deadline for you is actually December 7th. What is your plan B, CD?
Well, plan B is you shut down and then try and reroute your supply chains, so in other modes of transportation. But as I said, the fact is there isn't enough capacity, there isn't enough availability in other modes of transportation to replace rail. So for the ag economy, for the food economy, we need the rail system in order to move products, not only for consumption by people, but also for humanitarian purposes, as I mentioned.
One final quick question, Dave, on the future of Cargill. You are going to be stepping aside as CEO. Brian Sykes is going to be stepping in and sitting in your chair. Does anything change? Do you think the strategy remains the same? You have focused this business on the protein business. Is that the strategy going forward? Does that remain the strategy going forward?
Well, it's been one of the focuses, Guy. It's not only been protein, but also we've really built up our oilseeds crushing business. We just announced this week the purchase of an oilseeds crush facility in Kentucky, Owensboro. Brian comes from the protein business, but he has a broad perspective outside of protein. He did a great job of refreshing and updating our strategy, or what we're calling Cargill 2025, to our board of directors just a few months ago. So I think in the short term, as I did when I took over 9 years ago today, as a matter of fact, continuation of what's working, but every CEO, every leadership team has their own traditions and customs and strategies, and he will have his own, and certainly that'll include protein, but between protein, oilseeds, bioindustrials, we're moving into salmon. We just purchased a 50% interest of Sanderson Farms this summer.
Yep.
So protein will be one amongst many, but Brian will set his own course with our leadership team, and he is the right person to be leading Cargill for the future.
All right, Dave, but don't be a stranger. We'd love to continue to chat with you and get you back. Dave McGlennon, Chairman and outgoing CEO of Cargill. All right, coming up, the consumer is still shopping. I did buy a pair of shoes today. October's personal spending numbers show Americans are still buying stuff, but there's a disclaimer to that. We can talk about it. We're going to talk more about this with Michelle Meyer, MasterCard Economics Institute Chief U.S. Economist, next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. In South Africa, President Cyril Ramaphosa is considering resigning over an advisory panel's report that he may have violated the Constitution. Bloomberg's learned that Ramaphosa is in meetings with allies looking for advice. The controversy has to do with a robbery at the president's game farm. 3 years since the world's first documented coronavirus patient in China, the country is finally pivoting away from efforts to quash the pandemic. China's COVID czar says the fight has entered a new phase and the government is making some concessions, such as allowing some low-risk patients to isolate at home instead of in controversial quarantine camps. And a key gauge of U.S. consumer prices posted the second smallest increase this year. At the same time, spending accelerated. That offers some hope that the Fed's interest rate hikes are cooling inflation without sparking a recession. The personal consumption expenditures price index, excluding food and energy, rose a lower than expected 0.2% in October. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy.
Ritika, let's stay with that theme, spending and inflation. Of course, it was the main focus of Fed Chair Jay Powell's speech at the Brookings Institution yesterday in Washington, sounding caution basically on reading too much into the declining inflation we're seeing in the data at the moment.
Down months in the data have often been followed by renewed increases. It will take substantially more evidence to give comfort that inflation is actually declining, and by any standard, inflation remains far too high.
Powell's not there yet, certainly on the inflation front. Higher prices apparently did not stop shoppers, as we've seen today in the PCE data. I thought the income line was pretty interesting as well. We get MasterCard data as well, which is definitely worth focusing on as we come out of the Black Friday into Cyber Monday story. Michelle Meyer, of course, is the person you want to talk to about this. She's MasterCard Economics Institute Chief U.S. Economist. Michelle, great to catch up. Americans have clearly been outspending. That is certainly demonstrated by your data. Are they spending more and getting less? What is happening here right now? Is it just inflation is boosting the overall headline numbers, or are consumers actually spending more?
So I think it's a little bit of both, right? We're looking at nominal spending. So part of that is that there's still some inflationary pressure out there, particularly for things that maybe aren't typically in your holiday shopping basket, but are still quite relevant: food, restaurants, etc. So there's still a good amount of inflation there. But I also do think it's that consumers are showing up. And what we've seen in our data, which is really fascinating, is that so far in this holiday season, it's been a little bit of a fits and starts. So early October was very, very strong in terms of overall consumer spending. We had some moderation, particularly in things like apparel and department stores into the end of October and early November, and then a big acceleration, particularly for apparel, into the Black Friday period. So consumers seem to be really focused on the promotional period. They're spending for a reason. They're spending in a targeted way, but they are still very much out there spending.
What do you think is going to happen in December? And I'm interested in the restaurant category, because you don't really have discounts for restaurants, and that came in real strong.
Real strong, yes. Everybody's out going to restaurants. They're traveling. If you look at air bookings data, it's very, very, very robust into the end of the year. So I do think that there's been these shifts in the consumer basket that's been happening over the last several years and still very much in play, where today consumers are prioritizing experiences. That's restaurants, it's travel, it's theater, and there's some deprioritization on these big durable goods. So we are seeing weakening in furniture sales. That's related to this pullback in the housing market that's been quite notable and quite severe across parts of the country. So there's shifts in the consumer basket. Consumers are making choices, and certainly right now the priority is remaining to be going out there, spending, experiencing their spending.
How are they funding the spending, the consumer right now? Is it credit? Is it savings? Is it income? I mentioned that pickup we saw in the income line in the PCE data today. What are we seeing here?
So Guy, you just mentioned it exactly right in your forward, that you have this big increase in nominal consumer spending, but you also had a big increase in disposable income. So the way I think about it simply is that there's three sources of purchasing power for the consumer right now. One is income creation. That comes from the fact that the labor market is still adding jobs on net. You talked about earlier in the program that there's certainly announced layoffs that are happening. Certain sectors are starting to see some job cuts. But on aggregate, we'll see what tomorrow shows, but it's expected to have continued robust job creation. So income is still flowing in. The second source is pandemic savings. Consumers use maybe about a third of those pandemic savings. So they still have the ability to draw down that cash and use that to finance spending in a targeted way. And then finally, it's credit card debt, which consumers were deleveraging after the initial stage of the pandemic. Now they're utilizing their credit cards more. These three sources of purchasing power were really, really powerful throughout this year, and they're still quite relevant as we look ahead into next year.
So Michelle, to that point, the savings that they have, how much of that do they spend? Because in the middle of a recession, because I feel like that's going to be the predictor for what happens in 2023, right? Do I sit on my savings or do I use it to help myself?
So if you look at the aggregate numbers, about a third of those savings have been used. So there's still a lot of cash out there. There is a question about the distribution of those savings by demographic group or income cohort. There is a question about the desire to spend. How much precautionary savings will consumers want to engage in into next year if and when we see a weakening in the labor market and income creation isn't as robust? So that could certainly be a factor. So I think, this time last year, those three sources of purchasing power were really, really strong. You had tons of reasons to save and to use debt, et cetera. Into next year, they're not as powerful, but they're still important sources that could help drive spending.
Michelle, I've got two questions. The first one is, how should the Fed read your data? The second one is, are you really in purchase? Is that deliberate? I'm assuming it must be.
Yeah, pardon. That is a great question, and honestly, I hadn't thought of that until now. But yes, MasterCard is in purchase in Westchester, and that is a perfect place for us to be, clearly. To your first point around how the Fed should read the data, I think it tells them that the consumer still has the ability to spend, which means that they still have the ability to handle some price increases, that the inflationary pressure is not gone yet. And that does necessitate further increases in interest rates. That said, they do need to, I think very importantly, look at the different components within the consumer basket. Where are they seeing that pullback? And what does that mean for deflationary pressure? And they are seeing that pullback in those big, durable goods. And that is where you're seeing some price discounting. So to me, the story going forward is to look at the economy in a divided way, right? Which parts are seeing that transmission of monetary policy and how painful is it, and is it filtering into the broader economy? Those sector data points, the micro data, is really important right now.
Michelle, really appreciate it. You're in purchase, Guy should be in Snarkyville, and I should be in Shoeville, I think is how we can determine all of that. Good to see you, Michelle. Michelle Meyer, MasterCard Economics Institute Chief U.S. Economist. Thanks for joining us. This is Bloomberg.
So we're going to start counting you down to the close here in Europe. European stocks up by 0.8%. We fade a little bit the Powell rally that came out of his Brookings speech yesterday. I think the real takeaway from today, though, is the strength that we're seeing in the pound and in the euro. The dollar is definitely down. Euro dollar, we're now trading at 104.76. We had a little look above 105. The pound's been at 122 on the cable rate today. That's where the strength story comes through. We've got a German 10-year, though, that is also bid. So stocks and equities, the correlation absolutely amazing at the moment. 10 basis points lower. Bonds get a bid. We're going to talk about the Macron-Biden bilat that is happening right now. Jacob Kierkegaard is going to join us from the German Marshall Fund next. This is Bloomberg. Thursday, the 1st of December, behind door number one, an equity rally, excluding London, where banks and some of the commodity stocks are under pressure. But broadly across Europe, technology's doing well, telecoms are doing well, utilities aren't having a bad day either. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Spot one, that's where the Stock 600 is trading right now. We're up by around 0.9%. As I say, it is technology that is leading this off the Nasdaq rally that we saw post-Powell. The dollar is under pressure. There's the cable rate, 122.66. I had to double check it earlier. We're up by 1.75%. And keep an eye on what is happening with Credit Suisse. We are getting awfully close to the capital raise offer price. We're now trading at 268. I think this is the 13th day down that we see for Credit Suisse. That stock's down by another 4.89%. Things are getting really crunchy in Zurich. Alex.
Yeah, we were talking about that yesterday. Like, what happens if the stock price just keeps going down? Like, how low can it actually go? It's a legit question. All right, here in the U.S., we got the S&P trading a little heavy, though off the lows. We're pretty much flat on the day, still above that 200-day moving average. But that ISM was weak. We did see employment go into contraction territory, so that really the highlight of that. Now, two things that are weighing on overall markets. First of all, I should point out the Dow's underperforming. Do we care about the Dow? Maybe, because Salesforce is down by a whopping 9%. Yet another read-through of a tech company that's struggling and looking at a weaker economy in Europe and the U.S. You also had the co-CEO and vice chair also resigning. That was also a surprise. Costco also, if you're going to get into a recession, isn't Costco a place where you want to go? But if you back out gas sales, their November sales was just 4.6%, the lowest since April of 2020. So are we seeing kind of a deeper retrenching or just a reset post-pandemic? I'm not really sure on that. 210 spread, what we're watching, 72 basis points is where we sit into Jobs Friday tomorrow. Guy.
Alex, a little later this hour, we're going to get a press conference. Presidents Macron and Biden in that press conference. The bilateral, we understand, has started between the two. Emmanuel Macron's talking about wanting to fix the consequences of the war on our economies. He's talking about what is happening in Europe right now, the impact that the war is having on Europe, high energy prices, etc. He's pretty ticked off with the United States. In some ways, he's pretty ticked off with President Biden. The Inflation Reduction Act, he sees as not being a level playing field. He wants answers, he wants changes. The question is, do we get them?
Number one. And there's also other stuff to be upset about. Remember the submarine thing? And that deal with Australia, I mean, that made France very, very angry. So I'm wondering sort of how that filters through in the relationship between the two, which still looks quite friendly. We saw earlier when they were walking out, they definitely seemed to like each other. They had a private dinner last night with just the couples. Yep. So I'm curious as to how that kind of stuff, the really contentious stuff, comes up.
They're eating American cheese tonight, I understand. I wonder how that's going to go.
It's like Kraft?
No, I'm assuming it's slightly different to that.
Okay, because Kraft would be bad. Eating Kraft cheese is
the French have views on cheese, which I think need to be taken seriously. The issue of the Inflation Reduction Act, though, I think is absolutely front and center. Europe feels like it's being penalized by this war. It is being penalized by this war. It is now they're going to rely on the United States for energy going forward. There is going to be a new relationship that's going to be developed there. So I wonder how far we can go in terms of the annoyance that Europe feels about the Inflation Reduction Act. Maybe we just need to see a European Inflation Reduction Act. Maybe that's the way to go.
But at the same time, I feel like Europe's in a unique place too, because they're also still trying to cement closer ties, economic ties with China. And clearly the U.S. also has ties with China as well. But as you were pointing out earlier, it feels like you have Europe and then you have China on one side, U.S. on the other. Yep. Can you have all your cakes and eat them at the same time?
One would hope so. You've got Charles Michel. So here's the other thing. You've got Macron in Washington, D.C., talking to President Biden, making the case there. But you've also got Charles Michel from the European Council in China, meeting President Xi a little bit earlier on. And that, I think, just exemplifies, is emblematic of the challenges that Europe faces right now. There they are a little bit earlier on. Europe doesn't know which way to look. It's being asked by the United States to make a decision. It's being pushed by the United States to make a decision. And you saw a little bit of that a little bit earlier this week at the NATO meeting in Bucharest as well. NATO's starting to pivot maybe towards focusing on China as a threat as well. You saw Stoltenberg talking about this, talking about the threat, talking about Taiwan. We talked about this on the show yesterday with Bilal Hafiz from Macro Hive. This is what he had to say.
Europe, on the one hand, is facing much higher energy costs on a long-term basis, notwithstanding the current mild winter. But also, the US is tightening the screws on Europe with its relationship with China. On top of that, the US is massively subsidizing its own production onshoring. So that really leaves Europe stuck on its own. And it really brings into question whether the German industrial model really is fit for purpose right now.
It's going to have to make a decision. The US is going to have to push it maybe to make that decision, but maybe that decision has to come. Let's talk about US-European relations. Let's bring in Jacob Kierkegaard, Senior Fellow at the German Marshall Fund. Jacob, always great to get your take on what is happening here. Are the Americans going to make Europe make a choice? Is it China or the United States? Is that the direction of travel here?
No, I mean, they would obviously love for Europe to make that choice, but ultimately they will fail. I think, the Europeans have clearly signaled that they're not going to be willing to officially take sides. But, the reality is that they have moved quite far in the direction of the United States. There aren't much Huawei IT equipment and the 5G networks in Europe. And, the chips semiconductor sanctions will also be adhered to by the relevant European companies. So, from the perspective of the United States, we're getting there, quote unquote.
What is the relationship that Europe eventually wants to have with China? Like, what's the ideal there?
No, I think many in Europe continue to cling to a version of the liberal idea that if we just keep trading with China, they're etc. That's what a lot of Europeans would like. But there is a growing segment of Europe that would want a relationship with China that is more like that of the United States, namely one that focuses on human rights, focuses on the issues of Chinese industrial policy, anti-competitive practices, etc. So, and public opinion in Europe is shifting on this issue.
Let's talk a little bit about the Inflation Reduction Act. The French president, we're looking at pictures now from just a few moments ago at the start of the bilateral meeting with President Biden. He says that the Inflation Reduction Act creates a uneven playing field. Is he right? Is there anything he can do about it?
No, I mean, he's certainly right that the Inflation Reduction Act is blatantly protectionist and against WTO rules. There's no doubt about that. But I think we should also be clear that, the political reality in Washington, D.C. is that if this bill had not been protectionist, it would not have passed, and the federal government would not have spent $370 billion to promote the number of the actual economic harm done to Europe from this act, I think is very limited, because the reality is that Europe's own green industries are producing right now at basically 100% capacity in order to fulfill the orders and the investment needs of Europe's domestic market. So therefore, again, there's not much harm done. Not many European jobs are going to be lost from this. What Macron rather wants instead, in my opinion, is a rethink of the European rules on industrial subsidies more general, which is something that the French have obviously been advocating for many years. So right now he's using this inflation reduction.
Yeah. Jacob, we're having some connection issues, so we'll have to leave it there, unfortunately. Jacob Kierkegaard, a senior fellow at the German Marshall Fund. But this raises the question how Europe can sort of do its own kind of subsidies when it comes to EVs or semis. Anyway, we're going to get much more on this throughout the program as we look forward to that bilat with President Biden and President Macron. In the meantime, coming up, Ramaphosa's cash in sofa scandal. This is kind of unbelievable. South Africa's president is considering resigning after a panel found he may have violated the Constitution. We'll get details next. This is Bloomberg.
Tomorrow, all eyes are on the jobs report.
Jobs report Friday is going to be huge.
It's the final stretch of 2022.
Is there actually going to be some change in the tone?
Wage data might be more important than the CPI.
Tomorrow, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is stronger than people have thought it would be.
The recession is not here yet, but the check is certainly in the mail.
We're going into a downturn at full employment.
The November jobs report, tomorrow on Bloomberg Television and Radio.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. One of the European Union's top officials has warned Elon Musk to keep Russian propaganda off Twitter. The EC vice president told Bloomberg that failing to take on fake or misleading content online could lead to a very quick abuse of Twitter. It's the latest warning shot over the possible side effects of mass resignations